Welcome back to this Money Control live stream. You're watching Closing Bell with me, Nandita Khemka, and my colleague here.
Hello there, I am Yatin Mota.
Well, Yatin, it has been a crazy one-way up move on the last street of the last six sessions. But today, would go down as a day when the bulls have taken a breather. We were managing to hold out in the green for the benchmark indices for the greater part of the session, but towards the last half an hour or so, we saw some bit of that momentum fizzle out a bit. In fact, the indices also gave up their gains and ended near the low point of the day.
Yes.
We managed to sustain the 23,600 mark, but important point to note is the fact that we did cross that 23,800 mark, on an intraday basis. In fact, today's swing high, if you look at the level, it's at 23,870. So perhaps that would become the next resistance level on the index. But the broader end of the markets, have had an off day since the first half itself. Both the Nifty mid and small cap indices shed anywhere between 1 to 2%. The breadth also, of course, turned negative, with the advanced decline ratio on NSE at almost 1:4. So you just had 560 stocks advancing to 2,100 stocks declining. And mind you, most of the sectors were trading in the red today, led by autos and pharma. Of course, Trump has indicated that there would be fresh tariffs coming in on autos and pharma. Perhaps that's one reason why pharma and auto stocks are under pressure. But one pocket that held out today, and that has, of course, been subject to quite a bit of drubbing over the last few sessions, was IT. Yesterday, remember, IT was among the gainers, gained somewhere around 1.5%. Today as well, defying the broader trend in the market, the IT index managed to hold out. In fact, gained somewhere around 1.5% or thereabouts. Yesterday, of course, there was a report by CLSA, and today, of course, we had another report by UBS, which signifies or which says that there could be some bit of turnaround coming in for IT
True.
stocks, and all the pessimism may already be in the price. So that was one pocket that held out. Nifty Bank Index also deserves mention, Yatin. It clocked that 52,000 mark in today, but cooled off from the day's high, ended somewhere around 51,600 or thereabouts. In terms of individual movers, then let's take a look at some of the stocks. UltraTech Cement, of course, there was a report by UBS on cement and how demand could see an uptick and earnings upcycle maybe in the offing in FY26. Because of that, we saw UltraTech gaining quite smartly, top Nifty gainer. Bajaj, Finserv, Trent had a good day today for a change. Grasim, Infosys, Axis Bank, some of the other movers. On the flip side, IndusInd Bank, top laggard, I think another 5% cut coming in. Dr. Reddy's, Adani Twins, Coal India, and autos like Bajaj Auto and M&M were under pressure. But Yatin, graphite stocks, electrode stocks
Yes,
were, actually gaining quite a lot, rallying, so to say. And of course, backed by heavy volumes as well, if you look at the broader markets.
Yes. If you look at the overall, market, it was quite mixed. In fact, the advanced decline ratio also was quite weak. In fact, today the advanced decline ratio was almost 1:4, clearly indicating that there was a huge profit taking in the mid and small caps. So obviously, after a stupendous, rally, we have seen, some bit of pressure in the market. Now, if you talk about Nifty mid cap index, so that was down 550 points, almost a percentage point down. Small cap index also down nearly 250 points, a percentage and a half loss there. When you talk about the gainers, HEG, Graphite were gaining in trade, 8 to 10% kind of gains coming in there. Blue Dart and PTCI, these are the two stocks gaining anywhere between 5 to 10%. But what was not doing well, the momentum boys, Dixon Technologies down 7%, Zomato down 6%, Himadri Specialty Chemicals down 6%. In general, a few of these stocks in which there was some bit of momentum have seen profit taking quite aggressively ahead of the expiry week today.
All right, those were the movers in the broader end of the markets. Of course, the texture changed when it comes to the broader end of the markets, but who knows whether it's just a one-day reprieve, a one-day, breather, or I don't want to say that's the start of a trend. Of course, it's because this kind of a move has come in after 6 straight days of
Yes.
strong gains. So let's not really talk too much about that. But of course, let's talk about the IT pack that was, of course, again hogging the limelight today. There is a positive note coming in from UBS. Of course, there's been quite a lot of pessimism when it comes to IT. Stocks have corrected 15 to 20% in the last 3 months. In fact, if you look at the PE multiples, they've also corrected anywhere between 12 to 20% over the last 3 months. Of course, there have been expectations of earnings deceleration. There have been concerns over a recession in the US, and
Yes.
that could delay the recovery that everybody was anticipating when it comes to consumer discretionary spends. So because of that, a lot of pessimism has been built in. And of course, UBS has also pointed out that they had discussions with managements of IT firms, and they've suggested that while uncertainty has really gone up, but the impact on client spending has been marginal. And of course, they are expecting, UBS in fact is saying that expect somewhere around 5 to 7% consensus earnings cuts, but they are also saying that FY26 could still be better in comparison to FY25. Of course, there could be a potential rebound in sector valuations as well. If you look at the IT pack on a YTD basis, it's down somewhere around 13%. In the last 3 months as well, if you see the performance of the Nifty IT index, it's down somewhere around 13% or so. UBS is saying that multiples can be expected to recover somewhere around 5 to 10% to average around those FY25 levels in the near term. Now, a couple of factors that could in fact aid tech spending going forward, despite the growing concerns over a slowdown in the US economy, and they are Fed rate cuts. Remember, Fed has once again reiterated the fact that they would look at 2 rate cuts for the year. Despite concerns over what inflationary impact the tariff hikes can have. So basically, Fed rate cuts as well as a cut in corporate tax. So these are some of the factors that could still aid tech spending, and of course can counter the US slowdown woes. Remember, Trump has made a case to cut corporate taxes to
Yes.
15% from 21%. So these are some of the factors that could aid consumer tech spending. That, of course, is a key monitorable when it comes to our IT firms. In terms of valuations, UBS says that Nifty IT is at a 5% discount to its 5-year rolling average. TCS, in fact, trading at 1.1 standard deviation below 5-year average. Infosys trading 0.6 standard deviation below 5-year average. And they are also saying that they are seeing counterbalancing forces. That means they're seeing more upside than downside on some of these IT names. UBS has buy calls on 4 stocks: TCS, Infosys, Wipro, as well as HCL Tech, while it has a sell call on a Tech Mahindra. Now, I just want to take you through what CLSA also said yesterday, which is what triggered this up move in IT stocks after a fair bit of grubbing. CLSA has maintained that uncertainty is already priced in. A lot of pessimism is already built into current valuations, according to CLSA, and they have said that they do see postponement of discretionary demand, but that too by 1 to 2 quarters, not more. And they are saying that they are seeing discretionary projects getting pushed out more in retail and manufacturing, where there'll be a direct impact of tariff hikes in April. For when it comes to constant currency revenue growth, they have lowered the FY26 forecast by 3 to 4%, and EPS cuts for FY26 are limited to somewhere around 1 to 3%, and that too due to rupee depreciation. Of course, there will be focus on cost optimization deals amid uncertain macros. Aside of that, I think CLSA had already, yesterday upgraded HCL Tech. That was the most preferred one among all the IT names, but it has still kept outperform rating on the likes of TCS, Infosys, Wipro, as well as Tech Mahindra. So yes, there is a concern, slowdown concern in the US, but all of that pessimism may already be in the price, and 2 of the brokerages have already pointed it out.
Absolutely. And, IT stocks, there has been a mixed bag. What if the US goes in the recession, and what if the tariff were to be milder than what the market expects? With a milder recession, will IT stocks do better, given the fact that US is also looking at tax cuts? So a lot of questions, rather than answers for the IT sector so far with respect to the North American business. So we'll watch out for this space. Shifting gears from IT to FMCG, and the slowdown here doesn't end. In fact, the brokerage reports suggesting that Colgate, which hosted a select analyst meet recently, has hinted about a possible slowdown which is happening across the board. In fact, Colgate management is of the view, in terms of the key takeaways, that muted growth environment with higher base and weaker demand has led to a big impact. Probably the margins will also remain under pressure because of promotion as well as discounting in specific products. Also, if you look at overall volume growth, that is expected to be lower. Promotion costs are going up. In fact, there could be a margin pressure which could be seen for the next couple of quarters, because of which the shares of Colgate also saw a dip in trade today. In fact, if you look at the price increase taken in Q4 is not likely to reflect in margins, because there is a higher promotion cost that I was mentioning earlier. So in general, the sense is that the frontline FMCG stocks have been witnessing some bit of pressure. Obviously, there are local brands. There is, the entire gamut of, e-commerce sales, which are boosting FMCG sales for smaller players, which are becoming bigger in size versus, the traditional FMCG companies. So competition, promotion, as well as some bit of slower volume growth is likely to create headwinds for these FMCG names. So the stock of Colgate ended, 2-3% lower in trade today,
Hmm.
possibly on a hint of probable slowdown in overall earnings growth.
That's true, Yatin. And volume growth concerns have already been persisting for
Yes.
FMCG names, which is, I think, one reason why FMCG has also been sitting out of this big up move that we have seen in the market. In fact, shares of Colgate Palmolive hit a 52-week low today,
Yes.
Yatin.
Yes.
And, at a time when some of the mid caps have staged a very
Hmm.
smart comeback, 30 to 40% up from lows, Colgate hasn't really
Hasn't.
managed to do
Yes.
that. In fact, on a YTD basis, the stock is down 12%. And if you look at the analyst views or calls on the stock, I think 13 of the 34 analysts who cover the stock have a sell rating on the stock. So yes, Colgate not showing its teeth as of now, and even
No
unlikely to do
smiles.
so in the fourth quarter as well. But another pocket that saw big action today was the cement pocket, right? Given the fact that we have a very bullish report coming in from UBS once again. I think there was a long build up also, in cement names in the FNO end today. Of course, UBS, it has upgraded three stocks from this pocket: UltraTech Cement, Ambuja Cement, as well as Dalmia Bharat. UltraTech, as we know, was the top nifty gainer today, 3.5% uptick, although it has maintained its buy rating on ACC. It sees almost a 20% uptick on stock prices of these four cement names that I mentioned from current levels, although it has upped its target by as much as 40% on an UltraTech cement. It has upgraded the stock to buy. Target price has been raised to 13,000 rupees from 9,000, from its earlier target of 9,000, which is a 45% bump up. And if you compare it to yesterday's close price, an 18% uptick is what it expects on this particular counter. For Ambuja as well, upgraded to buy, target price raised to 620 from 475 rupees, 20% upside here as well. For Dalmia Bharat, I think it has upgraded to buy from sell, and target price is at 2100 or thereabouts, again at over 20% bump up from current levels. For ACC, buy rating, target price at 2250. Now it is betting on an earnings upgrade cycle from FY26. Remember, cement counters weren't seeing all great action, given the fact that it was an election year
Hmm.
last year and there was slowdown in spending as well, government capex. So that impacted cement firms as well. But UBS says that there would be key drivers for demand going forward. There would be housing, infrastructure, commercial projects. That will there'll be a lot more spends on that. There'll be revival in government capex, and volume, of course, is projected to grow at 7 to 8% annual rate, aligning with or slightly outpacing the real GDP growth. It also says that cement companies may see cost reduction, which will aid margins going forward. What are the factors that will lower costs? Well, transition to renewable energy. There'll be reduced freight costs due to increased rail transport, as well as improved logistics driven by mergers. A lot of mergers, acquisitions,
Hmm.
of course, have taken place over the last year when you look at the cement space. And market leaders, according to UBS, hold the upper hand here as consolidation continues. Sector consolidation, of course, led by the likes of UltraTech and Ambuja. Benefits of consolidation that will accrue to these players are quite a lot, including wider geographical reach.
Yes.
For instance, of course, UltraTech acquired India Cements, and that will give it a wider footprint in the southern part of the country. And for Ambuja's merger with Sanghi as well as Penna Cement acquisition, it would widen its footprint both in western as well as southern
Hmm.
regions. So yes, there is a fight for market share and a lot of consolidation happening, and that will also give them access to crucial limestone reserves, as well as economies of scale. Even in terms of prices, after an 8% drop in prices, they may have bottomed out. That's what UBS says.
Hmm.
The 8% drop that I was mentioning was, over the first 9 months of FY25. So yes, things looking up for cement, and the demand drivers are in place. So of course, it's a fairly bullish report, and we saw stocks like UltraTech actually reacting to it. So let's see better days ahead for cement names. Maybe they would be looking at cementing more gains going forward.
Yes, and I think after this report, there was good traction in the cement pack at large. And obviously, if you talk about cement companies' guidances, they're expecting a stronger Q4 because the first half was impacted by monsoon, which was slightly prolonged this time. And with probably the summer season or the March quarter, which is typically good for infra companies, housing companies, cement companies are expected to report better sequential earnings, or probable volume growth tailwinds are there for the sector.
Well, then those were the stocks that were on our radar this afternoon. Of course, today we can call it a day of consolidation. Things may have normalized a bit after the solid one-way move that we've seen on the Lal Street of the last 6 sessions. Let's hope tomorrow we resume this rally after a one-day break. Let's see what happens. But then with that, I think it's a wrap on this edition of Closing Bell. Thanks a lot for tuning in. Have a great evening and stay tuned to Money Control for all your other news and updates.